As mentioned, stocks are on pace to break their 8-day winning streak today, while yields are also on the move lower. These two have been inversely correlated for the last couple of years, with equities selling off and the TLT rallying. It moves higher when yields fall as recession fears ramped. But while the recent spate of strong data subdued hard landing fears and spurred stocks higher, the TLT kept climbing. And my next guest says there's no way they can both keep moving higher. So which one is mispriced? Let's ask BTIG Chief Markets Technician Jonathan Krinsky. All right, Jonathan. Not that I'm easily confused, but remind me again. So are we in the 2010s paradigm or the inflation paradigm here with stocks and bonds right now?
Yeah, so we think, obviously 2022 and for the most part of 2023, inflation was the main concern for markets. And as you mentioned, stocks and bonds were inversely correlated. So when we saw, higher inflation data, bonds would, they were positively correlated. Bonds would sell off, yields would go up, stocks would go down. I think since about mid-July, when the market really stopped worrying about inflation, it's pretty obvious that's on the path towards the Fed's target. I think the market's focus has shifted towards growth dynamics. And, we saw a couple ugly prints on the economic front in early August we had a spike in claims. We had a really poor ISM manufacturing number, and then that when the jobs data came out, we had an unemployment rate up to 4.3%. We saw bonds rally firmly on the back of that, and stocks sold off. And then really since over the last week or two, we've continued to see bonds rally, even though the data has arguably been quote unquote better, which has led to the stock rally. So we think one of two situations: either if bonds are telling the truth and maybe the economic data is actually slowing, stocks are probably poised to pull back a bit here. And if stocks are right and the data is better, then we probably should see bonds pull back here. So maybe a bit of both, but we think when we look at the landscape for equities after 8 straight up days, we've actually started to see the fear that we saw in early August do a complete 180. Yesterday was the lowest put-call ratio for equities since July of 23 and the second lowest composite put-call ratio. So we've gone from complete fear in early August to a bit of complacency here.
So you're among those who think we've come back perhaps a little bit too far too quickly.
I mean, look, it's really a function of your time frame. One of the things there was a bit of an anomaly in the early August lows is we never got a full breadth washout, which is, what we looked at is when you have a 5% or more drawdown in the S&P, you almost always get a washout with less than 20% of stocks on the S&P above their 20-day. We never got that full washout. So it would be a historic anomaly not to get that. Now, we've probably gone a bit too far to really stick to that thesis. So we've been saying, rather than a retest of those August lows, maybe we're looking at something more like 5,400, but that's still almost 200 points lower here. So when you add that up, looking at the complacency we just mentioned, we think, very tactically, the next move is probably lower. If your time frame is a bit longer, even if you're looking at a year end, you're probably a bit okay. I just don't think it's, the time to get aggressive with buying was in that VIX spike, in early August. This is probably a bit late for tactical buys.
Yeah, no, I guess you had about a 10-minute window to do so. Obviously we've all been pondering this, and there is one alternative. It doesn't necessarily have to be one or the other. You could have stocks rallying because yields are falling, because inflation's receding and the Fed's going to start cutting, and that's actually supportive of an ongoing rally, and quite supportive. I mean, I know the Russells are down today, but quite supportive of certain names for whom high interest rates were a really big headwind. So I'm trying to believe in the Goldilocks outcome here.
Yeah, I mean, look, there's definitely some parts of the market that benefit from lower rates for sure. I think, if you look at the reaction in the bond market and equities to the recent economic data, the move in claims and even retail sales last week was much bigger than the move we saw for the August CPI report. So I think it's clear the market is moving past inflation. It's not to say it doesn't care about inflation, but I think that, the narrative over the next, 12 to 18 months is going to be a growth dynamic. And that probably means if we see lower yields, that should mean lower stock prices, and we just haven't seen that over the last week or two. So there's going to be periods where the correlation isn't perfect, but I think that's the message the market is sending with its reaction to the recent data.
All right, Jonathan, thanks for joining us. Appreciate your time.